So these three theories, they differ in terms of the question of when a bank lends money, where does the money come from? And so recently I thought, and obviously, I knew already in the early 90s the answer and used that in my work quite successfully also as economist and forecaster. We can come to that. But I also wanted to end this debate and the fact that even in this day and age, people still think banks are financial intermediaries. So I conducted a few years ago the first empirical test of this theory. I mean, that's the scientific thing to do, isn't it? There's three theories. They say different things. What do we do? Well, we need an empirical test. Published 2014. If you Google, can banks individually create money out of nothing? You'll get it. It's the most downloaded, apparently, academic paper in all the Elsevier academic journals across all the various disciplines. So it made a bit of a splash when it came out 2014. Even the central banks then came out, Bank of England. Oh yes, banks create money. We knew that. We knew that. Well, they knew that, but they didn't publicize it. So, but let me tell you. So this study was essentially going to a bank and saying, well, this has to be real. So I'm really going to borrow money. Because the three theories of banking differ on that point. When you borrow money, where does this money come from? So we're going to go to a bank, a really functioning bank. We need access to their accounting system, and their IT essentially is all in the IT, isn't it? We need access to that, which was a bit of a big hurdle because that's all high security, isn't it? Customer data and so on. But for scientific research, I managed to get that. The BBC was actually filming as well. And the question then is, so does the bank, when the bank gives out a loan, so I really borrowed money, it was 200,000 euros, which would be what, $250,000 or something. And I told the bankers, well, no, I want to transfer this away to my own bank account at another bank. It needs to be, I really need to get the money. Otherwise, I don't want some kind of simulation or theoretical stuff. It has to be real. So they were quite nervous about this. Like, is this quite an elaborate scam? And this guy is just going to run with this money. And so then we did this. And the question then was, when I get the money booked to my account, where does the bank get the money from? Is it from deposits, customer deposits, as the financial intermediation theory claims? Or is it from excess reserves at, say, at the central bank, as the fractional reserve theory says? Because without excess reserves, you can't do the new lending. Or is it just, created out of nothing, out of thin air, invented? And, well, the conclusion was the money was invented. The deposits didn't change. The reserves, they didn't even check how much do we have in reserves, and was untouched. And it was simply newly credited to me. Now, if you look at the legal side, for those who are interested in this question, from the legal perspective, it's actually, it's most clear, it's, clearly visible what's going on. Because what the bank really does is when you get a loan, a mortgage, whatever, the moment you sign the loan contract, that can be considered, and the bank does consider it, as a promissory note that you've written. In other words, it's security. It's an IOU that you've issued as the borrower.
Of course.
And you promise, it's a promise to pay you to repay this money. So really, you've issued a security, like when the government issues treasuries. You've issued your loan, your mortgage treasury, your security. Okay. The bank now says, okay, we're going to buy that. And it puts it on its balance sheet as an asset, because now they have a claim on you because you promised to repay this money. And you say at this point, oh, actually, I don't care about these details, just give me the money. And if the banker is careful, the banker will say, you will find it in your account with us. They may carelessly say, oh, we've transferred it to your account. That would be technically wrong because no transfer takes place. That's what I confirmed in that empirical experiment, that when I got the money, it was not transferred from any other account. I mean, you can see where does it come from. and it didn't come from any other account inside the bank or outside the bank. So what is it? Well, at law, because the bank has got you a promissory note, it also, according to the loan contract, of course, owes you money as well, right? That's the money that you want in the first place. That's why you went to the bank for the loan. Now, that means there is an accounts payable liability that the bank has, because, you know, it hasn't paid you, but it needs to pay you. And therefore, on its liability side of the balance sheet, it will also record the same amount that it's already recorded as an asset when it bought your IOU, say $200,000, but they also owe you $200,000, an accounts payable liability. And now is the little trick. They will book this as a liability on their balance sheet, but of a different category. They won't actually say, oh, it's an accounts payable liability arising from the loan contract. That's really the truth.
Well, it puts it in plain English.
Yes, exactly. It puts it in plain English. This other paper is called How do banks create money and why can other firms not do the same? You can also Google it. It's open access as well. And so what they do is they don't book it as an accounts payable liability, which would be correct. They book it as a liability of another type, namely a customer claim on the bank that they call a bank deposit. Because what is a bank deposit? It's a claim by customers on the bank. And this is in English law well established for centuries, that there is no such thing as a bank deposit. That's not a legal concept. It doesn't exist. All there is a loan we've given to the bank. So deposits are actually loans that we've given to the bank. And that's what they put in on their liabilities. Well, we owe them money. That's how we record it. Now, the bank's record of the bank's debt to the public, that's what we call bank deposits. And that's our money supply. And so, of course, they can invent it out of nothing. And so then suddenly, when you look at the legal side, it's not so magical or surprising that, of course, they can create money, because really they're just adding more liabilities they have. And because the banking license gives them the right to put things on their balance sheet, accept deposits, the banking license is really the license to accept deposits, that means they can invent new liabilities on themselves, which they do when they give out a loan. Now, of course, the borrower has no idea about these details, right? And they think, well, I've got money here because, look, I've got it in my bank account, current account, it's there, and I've transferred to somebody else. And nobody realizes that that's just been newly invented by the bank on the back of the bank purchasing your IOU. And as banks do more of that, the money supply expands. And this is where actually now we're at the core question, because now I come back to Japan and the capital flows and everything. So if banks lend money, they create new money, they expand the money supply. And the key question now is, what is this money going to be used for?